I'm 99 years old. People ask me for the secret to getting rich. They expect a complex formula or a stock tip. I tell them, spend less than you earn and invest the difference. They look at me like I'm senile. They want magic. But there is no magic. The mistake people make is confusing simple with easy. The rules of wealth are incredibly simple, but following them for 50 years is the hardest thing you will ever do. Most people can't do it. They know what to do, they just won't do it. And that's why they stay poor. If you stop looking for magic and start following the math, wealth is inevitable. I'm going to show you the 5 simple rules that built Berkshire Hathaway. These are not theories. These are not guesses. These are arithmetic. Let me tell you why smart people stay poor. Most people think building wealth requires a high IQ, a secret formula, or complex trading strategies. That is nonsense. Getting rich is actually incredibly simple, but it is not easy. The truth is that wealth is just a byproduct of discipline and arithmetic, not brilliance. It comes from spending less than you earn and investing the difference in things that compound over decades. You don't need to be smart. You just need to be not stupid longer than everyone else. If you are looking for a shortcut, you will likely find a disaster. Hit the like button if you are ready to stop gambling and start building. I only share this with people who are serious about the long game. I'll show you the 5 simple rules that built Berkshire Hathaway. Rules that anyone can follow, but most won't. The first rule is the hardest. Let's start with the gap. Spending less than you earn. This sounds obvious. Everyone nods when they hear it, but almost nobody does it. And the consequences are devastating. Here is why. If you spend what you earn, you are a slave to the next paycheck. Every single month you are starting from zero. One missed paycheck and you are in crisis. One medical emergency and you are broke. One layoff and you are finished. You have built a prison for yourself and you don't even know it. You cannot compound zero. And here is the second problem. Desires grow faster than income. That is the hedonic treadmill. You get a raise, you immediately buy a bigger house, a nicer car, more expensive dinners. Your lifestyle inflates to match your income. The gap never opens. You are always spending exactly what you make. And suddenly you are right back where you started, broke just with better stuff. The third problem is that you become a status seeker. You buy things to impress people who don't like you with money you don't have. You are performing wealth without building it. That is the trap most people fall into, and they never escape. I watched this happen to a surgeon in Los Angeles. This was 20 years ago. He was 50 years old, high-paid, smart. Everyone respected him. He was earning $800,000 a year. Most people would think that is financial freedom. It was not. He bought the biggest house in the neighborhood, $4 million. Mortgage payment, $35,000 a month. Joined the country club, $20,000 a year in dues. Leased 2 Ferraris, $3,000 a month each. Private school for the kids, $60,000 a year. Vacations in Europe, $50,000 a year. He was spending $85,000 a year, $5,000 more than he earned. He was going backwards. And he did not care because he looked rich. His friends thought he was successful. He felt successful, but he was broke. He was a high-paid serf. Then he got arthritis in his hands, could not operate anymore. His income stopped, and in 3 months he was selling the Ferraris to make the mortgage payment. 6 months later, he sold the house at a loss. A year later, he was working at an urgent care clinic for $150,000 a year, still trying to maintain the lifestyle, still pretending, still broke. The man made more in 1 year than most people make in 10, and he had nothing because he never created the gap. His entire financial life was a performance, and when the curtain fell, there was nothing behind it. Here is the arithmetic. If you earn $100,000 and spend $100,000, you have zero to invest. 0 times any rate of return is still 0. You cannot compound 0. It doesn't matter if the stock market goes up 10% or 50%. You are not in the game. You are sitting on the sidelines watching other people get rich while you tread water. But if you earn $100,000 and spend $80,000, you have $20,000 to invest every single year. That is the gap. And that gap is everything. $20,000 invested at 8% annual return becomes $573,000 in 20 years. Not because you were brilliant, not because you picked the perfect stocks, just because you created the gap and let it compound. That surgeon who spent everything 20 years later, he has nothing. The person with the gap has over $500,000. Same time period, different discipline. That is the power of the gap. Now let me be clear. Creating the gap is not about deprivation. It is not about living in a cave eating beans. It is not about being miserable. It is about living below your means on purpose so that you have capital to deploy. Capital is freedom. Capital is power. Capital is a safety net. Capital is the difference between being powerless and being dangerous. When you have capital, you can walk away from a bad boss. You can take a risk on a new opportunity. You can survive a recession. You can say no to things that don't serve you. Without capital, you are a slave. With capital, you are free. Wealth is what you accumulate, not what you spend. People who understand this create the gap. People who don't understand this stay broke forever. Create the gap. Once you have the GA, you need a hill. Rule number 2 is the snowball, reinvesting. Here's what most people don't understand about compounding. Arithmetic is exponential, not linear. The growth curve is not a straight line, it is a hockey stick. And the hockey stick does not happen in year 1 or year 5 or even year 10. It happens later, much later, and most people quit before they get there. The first few years look like nothing is happening. You invest $20,000. A year later, it is $21,600. You made $1,600. You think that is pathetic. Where is the fortune? You expected to be rich by now. Your friend who day trades stocks tells you he made $5,000 last month. You feel like an idiot sitting there with your boring index funds. So you quit. You pull the money out, you try something else, and you start over and you never get rich. That is not how it works. Compounding is slow at first, and then it is violent. The first 100,000 takes forever. The second 100,000 comes faster. The first million takes decades. The second million takes years because the base keeps getting bigger. That is exponential growth. But you have to let it run. You have to let it compound. And that means you cannot interrupt it. The problem is most people stop the snowball. They interrupt compounding. They pull money out for a vacation. They sell stocks to buy a car. They cash out to start a business. And every time they interrupt it, they kill the momentum and they have to start over and they never get ahead. I watched a small business owner in Omaha do exactly this. He was 65 years old when I met him. He owned a small dry cleaning chain, 3 locations. Started it in his 30 seconds, built it slowly, good business, decent margins, nothing fancy, but it made money. Every year the business threw off $50,000 in profit every single year. For 30 years, that is $1.5 million in total profits. You would think he would be rich. He was not. He was broke. Here is what happened. Every time the business made profit, he pulled it out, bought a boat, took a vacation to Hawaii, bought a bigger house, new cars, country club membership. He treated the business like an ATM machine, pulled cash out constantly, never reinvested a dime. The business stayed the same size, 3 locations, same equipment, same revenue for 30 years. Meanwhile, inflation ate his margins, costs went up. He could not raise prices fast enough. The business started losing money. He had to close 1 location, then another. By the time he retired, he had 1 location left, barely breaking even. He sold it for almost nothing, and he had nothing to show for 30 years of work. Nothing except used boats and faded vacation photos. He ate the seed corn. He could have reinvested those profits, bought another location every few years, 6 locations, then 12, upgraded equipment, hired better people, built a real business, let it compound. If he had reinvested half the profits, just half, he would have retired with 20 locations and a business worth millions. Instead, he consumed everything and the business never grew. It died slowly and he died broke. That is what happens when you interrupt compounding. Here is the arithmetic. If you invest $100,000 at 10% annual return and you reinvest all the gains in 30 years, you have $1.7 million, 17 times your money. But if you pull out the gains every year to spend them, you have $100,000 in principal plus $300,000 of gains that you already spent. Total value, $400,000. If you're lucky, the person who reinvested has $1.7 million, 4 times more, same starting capital, same rate of return, same time period. The only difference is reinvestment. That is the snowball. One person let it roll, the other person stopped it every year to pull out cash, and the difference is catastrophic. The big money is not in the buying and selling, but in the waiting. That is what Warren always says, the waiting. Let it compound. Do not interrupt it. Do not pull money out to buy toys. Do not stop compounding to pay for a vacation. Do not cash out to chase some shiny new opportunity. Let it compound. That is how you get rich. Warren and I call it sit on your ass investing. It is not glamorous. It is not exciting. It is boring. You do nothing. You just sit there and let time do the work. But it works. Most people cannot do it. They get bored, they get impatient, they want action, they want to feel smart, they want to tell their friends about their brilliant trades. So they trade, they buy and sell constantly. They interrupt the compounding and they stay poor. Meanwhile, the patient people who buy quality businesses and do nothing get rich. That is the whole game. Patience. The snowball requires patience, and patience requires discipline. And discipline is what separates the people who get rich from the people who stay broke. But you can destroy the snowball with one thing. Number 3 is avoiding the 3 L's. Liquor, ladies, and leverage. The first 2 will cost you money and dignity. The third one will destroy you completely. Leverage introduces the possibility of zero. It forces you to sell at the bottom, and it is addictive. Here is why leverage is so dangerous. When you borrow money to invest, you introduce a third party into your decision-making, the lender. And the lender does not care about your thesis. He does not care if you are right in the long run. He does not care if the business is great. He just wants his money back. And if the market goes down and your equity drops below a certain level, he forces you to sell at the worst possible moment. At the bottom, that is how smart people go broke. Not because they were wrong, but because they were leveraged. Let me tell you about Rick Garr. Rick was our partner, Warren Buffett, Rick Guerin, and Charlie Munger. The 3 of us were investing together in the 1960s and 70s. Rick was brilliant, one of the highest IQ scores ever recorded in the United States Navy. He took the test and left early. That does not happen. He was smart, aggressive, talented, and he was in a hurry. He wanted to get rich fast. Warren and I were patient. We were content to let things compound slowly. Not Rick. He wanted it now. So he used margin to buy stocks, borrowed money to increase his bets. And for a while it worked beautifully. The market was going up. His stocks were going up. He was making a lot of money. He looked like a genius. People thought he was smarter than Warren and me. Maybe he was, but he was leveraged and we were not. Then came the 1973 to 74 bear market. Worst market since the Great Depression. The market dropped 50%. Stocks that looked cheap got cheaper. Quality businesses were selling for nothing. It was the opportunity of a lifetime, but Rick was leveraged. And when the market dropped, his broker called margin call. You need to put up more cash or we are selling your stocks. Rick did not have the cash. He had put everything into stocks and now he was forced to sell. At the bottom, he had to sell his Berkshire shares. Sold them to Warren at $40 a share. Warren bought them happily. Those shares are worth over $500,000 each today. Let me say that again. Rick sold at $40. Today they are worth $500,000. That is 12,500 times his selling price. Rick got wiped out of the game, not because he was wrong about Berkshire. We all knew it was a great business, but because he was leveraged, he was in a hurry. Warren and I were not. We had no debt, no margin, no lender breathing down our necks. So when the market crashed, we just sat there, held our stocks, bought more when we could, and waited. Rick had to sell. That is the DI difference. Leverage took him out of the game. And here's the thing. Rick was smarter than me. He was probably smarter than Warren, but he used leverage and we didn't. That is why Warren and I are billionaires and Rick is not. That is why you have heard of Warren Buffett and Charlie Munger, but you probably never heard of Rick Guerin. Leverage. It killed his fortune. If you are smart, you don't need leverage. Your ideas are good enough without it. You will get rich anyway, just slower. And if you are dumb, leverage will kill you. It will turn small mistakes into catastrophic losses. Leverage is the only way a smart person can go broke, because it introduces a third party who can force you to act at the worst possible time. You might be completely right about an investment. The business might be fantastic, but if you are leveraged and the market goes down temporarily, you lose anyway because you are forced to sell at the bottom. I have seen this happen over and over again. Smart people, good investments, total catastrophe, all because of leverage, long-term capital management. Brilliant people, Nobel Prize winners. They had leverage. They blew up, lost everything. Lehman Brothers, smart people, they had leverage. They went to zero. Countless hedge funds, smart people, they had leverage. They disappeared. The pattern is always the same. Smart people think they can handle leverage because they are smart. They cannot. Nobody can, because leverage introduces uncertainty. And when uncertainty arrives, leverage kills you. It is seductive. It amplifies your gains when things go well. A 10% gain becomes a 30% gain. You feel like a genius. But it amplifies your losses when things go badly. A 10% loss becomes a 30% loss. And if the loss is big enough, you get a margin call, and then you are finished. Here is the rule. If you are smart, you don't need leverage. If you are dumb, it will kill you. Avoid it completely. Live below your means. Keep a margin of safety. Save capital. Invest conservatively because the world is uncertain and bad things happen. Recessions, bear markets, black swans, they always come. The question is, will you survive? If you are leveraged, you will not. If you are not leveraged, you will. And that is the difference between getting rich and going broke. That is why Warren and I never use leverage. Never, not once. And that is why we are still here, still rich, still in the game. While Rick Guerin and 1,000 other smart people got wiped out decades ago, avoid leverage. It is toxic. To keep the snowball rolling, you need fuel. Rule 4. Be a learning machine. The world changes. If you don't learn, you become obsolete. Knowledge compounds just like money, and wisdom prevents the stupid mistakes that destroy wealth. Let me tell you about a newspaper publisher in Chicago. He was 60 years old, successful, rich, built a big business over decades. Then came the rise of the internet in the 1990s. Digital advertising, online news, he refused to learn about it. People will always want paper, he said. He stopped learning at 40. He was obsolete by 50. The business went to zero. Kodak moment. Another brilliant man destroyed by his own rigidity. He assumed the world would stay the same. It didn't. And he didn't adapt because he stopped learning. Here's what I know. Warren and I are learning machines. We read constantly. We think constantly. We challenge our own beliefs constantly. And that is not because we are intellectually curious, though we are, but because the world keeps changing. And if you stop learning, you become obsolete. The skill that got Berkshire through one decade would not have sufficed to get it through the next decade. Without continuous learning, the record would have been absolutely impossible. I constantly see people rise in life who are not the smartest, sometimes not even the most diligent, but they are learning machines. They go to bed every night a little wiser than when they got up. And boy, does that help, particularly when you have a long run ahead of you. If you look at Warren with a time clock, I would say half of all the time he spends is sitting on his ass and reading. And a big chunk of the rest of the time is spent talking one-on-one with highly gifted people whom he trusts and who trust him. It looks quite academic. All this worldly success that is not an accident. Learning compounds. What you learn today builds on what you learned yesterday. And in 20 years, you have this vast reservoir of wisdom that makes decision-making almost intuitive. You see patterns other people miss. You avoid traps other people fall into, not because you are smarter, but because you have been paying attention longer. Go to bed every night a little wiser than you were when you woke up. Read widely. Study failure, especially your own. Challenge your assumptions. Surround yourself with people smarter than you and listen to them. Learn across disciplines. Don't just study your field. Study psychology, study history, study biology, because the big insights don't come from going deeper into your narrow specialty. They come from connecting ideas from different fields. I call it a lattice work of mental models. It is a fancy way of saying, understand how the world really works, not just your little corner of it. The final rule is the hardest for modern people. The last rule is deferred gratification, patience. If you can't wait, you become a victim of those who can. Impatience forces you into bad gambles. Crypto options get rich quick schemes. And the marshmallow test predicts life success. Let me tell you about a young tech employee in San Francisco, 25 years old, got a big bonus, bought a Tez, LA, and a Rolex immediately. Wanted to look rich now. 10 years later, he has no assets, just depreciation. The Tesla is worth nothing. The Rolex lost half its value. Meanwhile, his colleague bought Berkshire stock and drove a used Honda. That colleague is now financially independent. He ate the marshmallow immediately. His colleague waited. That is the difference. Here is the truth. Most people cannot wait. They want everything now. New car, big house, fancy watch, designer clothes, expensive vacations. They spend their money the moment they get it, sometimes before they get it, and then they wonder why they are not rich. You cannot get rich if you consume everything you earn. Wealth is what you don't spend. The marshmallow test is simple. You put a marshmallow in front of a child. You tell them if they wait 15 minutes without eating it, they get 2 marshmallows. If they eat it now, they only get 1. Most kids eat it immediately. A few wait. The ones who wait grow up to be more successful, higher incomes, better health, stronger relationships. Why? Because the ability to delay gratification is the foundation of everything. Saving money requires delaying gratification. Building a business requires delaying gratification. Staying healthy requires delaying gratification. Mastering a skill requires delaying gratification. The entire game of life is delaying gratification. And modern society is designed to make you fail at it. Instant credit, one-click buying, same-day delivery. Everything is designed to give you what you want right now. And that destroys your ability to delay gratification, which destroys your ability to build wealth. It is waiting that helps you as an investor. And a lot of people just can't stand to wait. They need action. They need excitement. They need to feel like they are doing something. So they trade stocks. They chase hot tips. They jump from one thing to another. And they stay poor. While the patient people who buy quality businesses and do nothing get rich. That is the secret. Do nothing. Just wait. Let time do the work. But nobody wants to hear that because it is not exciting. It is not sexy. It is just arithmetic. Now let me tell you about a man who mastered these rules. I learned these principles from my grandfather. He was my mother's grandfather. His name was Ingham. He came out to Iowa with no money but youth and health, fought in the Black Hawk War, bought cheap land when it was $1 an acre, stayed there for decades. That blacktop soil created a modern, rich civilization, and he became the richest man in the town, owned the bank, huge family, very happy life. He told his story over and over again to the grandchildren who hung around him. He said in a life like his, when you were located in the right place, you got a few opportunities. If you lived to be about 90. And the trick to coming out well was seizing the few opportunities that were your share when they came along. A few opportunities, not a million, a few. He bought a few farms every time there was a panic. Leased them to thrifty Germans. You could not lose money leasing a farm to a German in Iowa, but he only did a few things. My mother remembered the story because Grandpa Ingham told it over and over. She had no interest in money, but she remembered the lesson, and she told it to me. I knew Grandpa Ingham was right. I always knew from when I was a little boy that the opportunities that were going to come to me were few. And the trick was to prepare myself for seizing the few that came. That is not the attitude people have today. They think if they study a million things, they can know a million things. They think more action equals more results. It doesn't. You don't need a million opportunities. You need a few good ones. And you need to be read. Why when they come? That is the whole game. So I followed Grandpa Ingham's advice. I saved money. I learned constantly. I avoided stupidity. I waited. And when the few opportunities came, I seized them aggressively. That is why I'm sitting here wealthy. Not because I am smarter than everyone else, but because I followed simple rules and I did not quit. That is why I am telling you these rules. Let me make this simple. Here are the rules. Spend less than you earn. That is physics. You cannot compound zero. Never interrupt compounding unnecessarily. The snowball gets big if you let it roll. Avoid ruin. Leverage kills. Get rich slow. There is no shortcut. These are not complicated rules, but almost nobody follows them because they are not easy. They require discipline. They require patience. They require you to say no to almost everything. And modern people hate saying no. They want to say yes. Yes to the new car. Yes to the bigger house. Yes to the fancy vacation. Yes to every opportunity that comes along. And that is why they stay poor, because you cannot build wealth by saying yes to everything. You build wealth by saying no to almost everything except the few things that really matter. Let me show you the perfect example of someone who did this. There was a woman decades ago. She worked for a soap company. Nobody famous. She just lived modestly, bought quality American companies and never sold them. That is it. That is all she did. Bought and held. Nothing fancy, nothing complicated, no trading, no hot tips. Just bought good companies and waited. She died and left millions to charity, more money than most fancy traders ever made. How? She sat on her ass. She did nothing, just held good companies for decades and let them compound. Compare that to the smart traders who churned their accounts, bought and sold constantly, thought they were clever. Most of them are broke now, or working at 70. She sat, they acted, she got rich, they stayed poor. The difference is patience. She had it, they didn't. That is the lesson. Let me tie this all together. Here's what you need to remember. The gap. Spend less than you earn. The snowball. Reinvest everything and let it compound. No leverage. Avoid anything that can take you to zero. Keep learning. Go to bed wiser than when you woke up. Be patient. Wait for the few great opportunities and seize them when they come. It is not about brilliance. It is about consistency. Spend less, invest the rest, and wait. That is the formula. It is simple, but it is not easy, because simple and easy are not the same thing. Most people fail not because they don't know what to do. They fail because they won't do it. They know they should save. They spend anyway. They know they should be patient. They chase shortcuts anyway. They know leverage is dangerous. They use it anyway, and then they wonder why they are poor. Here is your challenge. Identify one expense you can cut today to increase your gap. Write it in the comments. Start the snowball now. Do not wait. Do not make excuses. Do not tell yourself you will start next month or next year. Start today, because every day you delay is a day of compounding. You lose forever. I am 99 years old. I have maybe a year left, maybe less. I am telling you this because I won't be here much longer to tell you. And I don't want you to waste your life chasing magic that doesn't exist. The formula is right here. Spend less, invest the difference, avoid leverage, Keep learning. Be patient. That is it. Follow those rules and you will be wealthy. Ignore them and you will be broke. Your choice. The first $100,000 is a but. You have to do it.